Well, good. We're happy to have you join today's NextGen Success webinar. I'm Nick Bright, Partner and Director of Financial Planning at Fiducian Advisors, working in the Wealth Office, which serves private clients. Happy to be joined by Colleen Dumke, a Senior Consultant, also working out of our firm's Wealth Office. For today's presentation, we thought it'd be helpful really to start with good financial fundamentals, or really laying a good foundation for longer-term financial success. That really starts with having a budget. The first question might be, does a budget really matter? There's a couple things to keep in mind from a budgeting perspective. First, it provides a framework for evaluating spending versus savings priorities, really enabling the individual to shift from a how much can I spend to could I be saving more mindset. And then secondarily is a psychological benefit from budgeting, that it may provide greater peace of mind. So a recent Schwab survey surveyed Americans with and those with and without a written plan, and found that 54% of Americans with a written plan feel very confident about reaching their longer term financial goals, versus only 18% for those without a plan. So when we talk about budgeting, really three broad categories to keep in mind: needs versus wants versus savings, and what we'll call the 50-30-20 rule. So when you're looking at your monthly income, thinking about 50% of your income falling in that needs bucket, which is comprised of housing, food, medical, transportation, and debt payments. 30% in your wants bucket, so that would be clothing, restaurants and bars, travel, and entertainment. And then last, but certainly not least, the savings bucket. So 20% towards an emergency fund, retirement savings, and extra debt payments. Now, it's important to note, if you find yourself in a situation where your needs bucket is more than 50% of your monthly income, that you really need to dial back from the wants bucket, not the savings bucket. So your mindset shouldn't be, well, I'll save whatever's left over. It should really be, hey, let's make a concerted effort to have a dedicated amount to savings. And then if the needs bucket's a little bit larger, we might have to dial down the wants bucket. And then I referenced an emergency fund just briefly. So as a good rule of thumb, an emergency fund should be at least 3 to 6 months of expenses. Recognizing that housing comprises a large portion of the needs bucket, some good rules of thumb as it relates to how much house you can afford. Thinking about your gross monthly income, the maximum mortgage payment should be no more than 28% of your gross monthly income. The total housing payment should be no more than 32% of your monthly income. When we say total housing payment, we're not only talking your mortgage payment, but we're also talking property taxes and homeowners insurance. And then all debt payments should be no more than 40% of your monthly income. Now, that might provide or present some challenges for individuals living in large metropolitan areas where housing costs might be high. So thinking about that slide we went over just a moment ago, if you find yourself in that situation, again, you might need to have some flexibility as far as dialing down the wants bucket. So important considerations to keep in mind if you find yourself on the fence of should I rent versus buy. So on the renting side, a handful of pros to think about. One, very low initial cost, low maintenance responsibility, and really greater flexibility to move. On the con side, there's no control over rent increases, which is certainly topical given what we're seeing right now from an inflation perspective. There's no tax benefits, and it doesn't build equity over time. On the buying side, there are some initial hurdles to get over. First and foremost, being significant upfront costs, which often require at least a 20+% down payment. There's ongoing responsibility for maintenance, property taxes, and homeowners insurance. And really one of the key considerations underlying the buy consideration is that you expect to stay in that area or home for multiple years. On the pro side for buying, housing costs are relatively constant once you have that locked mortgage payment, absent any major renovations or repairs. There are tax benefits associated with mortgage interest payments as well as property taxes. The property builds equity over time as you pay down that mortgage, and with the potential for appreciation. And then finally, there's a psychological benefit of a sense of stability or establishing roots.
Now, there's one thing in common when you're considering renting versus buying a home that'll happen for either of these instances, and that would be getting a credit check by those that you're renting from or from the bank that you'll require for a mortgage. And so what we can do as those in the next gen is start early in building that credit. So it may either happen from student loans in college or from a car loan, paying those monthly payments, or it can start by establishing a credit card. Getting a credit card in college is a lot easier as a student because the companies do not require you to have a prior credit history, or after college, you may be required to co-sign with your parent, but you can do that as well. And what you'll want to do to build that good credit is to pay bills down on time and also keep paying down your credit. So there's often a misconception of, oh, all I need to pay is my minimum monthly payment. Now, we recommend only charging to the credit card what you can pay off every month. We recommend paying that credit card off in full every month. What could hurt that credit score would be missing a payment, or if you're allotted $5,000 of credit, every month utilizing that full $5,000 of credit. That would not be recommended to build a positive credit score. Now, one thing we can do to make sure our credit score is in good standing for the time that we need it would be utilizing the free resource. We've listed a link on the slide where you can check your credit score for free on an annual basis. Now, whether we're saving for a home or we're saving for retirement, one important thing to consider would be investments and building up our investable assets over time. So now, what makes up that investable universe? You can see we have a couple of different asset classes that you can see on this page, whether it's bonds, stocks, real assets, think about real estate or commodities, and then alternatives, which could be private equity or hedge funds. Now, as you can see, as we move from left to right, bonds being more conservative, to the right could be more growth or risky assets. You can see that would be important. And what we'll talk about here today would be introducing this topic of diversification. We wouldn't want all of our assets in just the conservative bucket or in just the most growth-oriented bucket. Diversification would allow us to spread our assets over multiple different asset classes and spread that risk out. So why don't we talk about what is a bond? Bonds are debt securities that are promises to repay borrowed funds in the future. So you can buy a bond that's either through a federal and state government, a municipality, or through a company. Think about IBM. So why don't we look at that picture on this page and think we are the investor. We're purchasing a $100,000 bond from Microsoft. We'll have a specified period of time, think 5 years. We'll be promised a coupon of 3%. So each year we'll receive our 3% coupon. And at the end of our 5 years, we'll have that principal repaid. Now, as we move into equities, what is a stock? A stock would be an equity security that represents the ownership position in a company. Now, with fixed income and bonds, we have that coupon that's very consistent. It still can fluctuate with market conditions, but stocks can fluctuate just a bit more on a couple different factors. Some of these factors would include a company's cash flow, their income, their expenses. All of that would roll up into a company's earning, and that could impact the stock price. But it could also be impacted by a couple different factors as well. Think about inflation or interest rates, positive or negative headlines in the news, or even the pandemic. The pandemic negatively impacted the travel and leisure industries, but positively impacted technology. So now stocks come in a couple different styles, and we can think about United States, US, or non-US, foreign, international. We can think about growth versus value, large versus small. So there are a couple of different flavors that we can have all within equities. Now, when you think about growth, we would think technology, Microsoft or Apple would be one of those. Value would be more healthcare or financial. So that would be more Johnson & Johnson company or JP Morgan. And then we also have large cap all the way down to small cap. And we have these different levels within foreign or international assets as well. And they all range from different levels of risk within these styles. And so again, we're bringing up this topic of diversification, and it's really important within diversification to own different styles within everything that you see on this page to spread out the level of risk. Now, how can we invest in stocks and bonds? Now you can see we've listed two different vehicles for investment. We have individual stocks, and we also have stock mutual funds or exchange traded funds. Now you can do the same thing with bonds as well, but we'll talk about stocks for a minute here on this page. So individual stocks is where you can purchase Apple or Home Depot, shares of Walt Disney outright, where you can have complete control of the companies that you own in your individual portfolio. But the drawback is that it will be more concentrated and there will be less diversification. On the flip side, we could purchase into mutual funds or exchange traded funds and think about this as owning a pool of assets that would be managed by a company such as Vanguard or Fidelity, Schwab. And what's the benefit to owning a mutual fund is that it's a convenient way to invest in a diversified pool of assets. The drawback would be having to pay a small cost to the provider, Vanguard or Fidelity, for the management of that fund. So you can invest individually or in mutual funds or a combination of the two.
Thanks, Colleen. That was a great overview on ways to diversify portfolios. And I think when we're thinking about diversification from a high level perspective, it goes back to that old adage that everyone knows, don't put all your eggs in one basket. And that's really for two different reasons. One, no one asset class consistently outperforms all others. And second, no one has a crystal ball with perfect foresight to be able to tell what tomorrow's winner is going to be. So by diversifying assets, we're really trying to smooth the ride of the portfolio, but also maximizing the return for a given level of risk, as we've noted here, which is a possibility of prudent diversification. So we're talking about diversification. It's really across multiple levels, as Colleen just summarized. So diversification among asset classes, so bonds versus stocks versus real assets. Diversification by region, so US versus non-US markets. By style, growth versus core versus value. By size, large cap, mid cap, small cap, or even micro cap. And then by management style, one that perhaps we didn't cover too much, but whether you're passively investing to keep expenses low and just get index-like returns, or actively investing where you're hiring an individual manager with the hope of outperforming the index's return. There's a quote that's been attributed to Wayne Gretzky that he said, "I skate to where the puck is going to be, not where it's been." And I think that's a good takeaway when we think about diversification, that oftentimes investors make the mistake of trying to chase yesterday's winner rather than taking a longer term view. On this next slide, we give some perspective, just looking over the last 10 years. And while it's certainly been true that US equity markets have had a phenomenal run over the last 10 years, you can see return variability year over year in the different shades of asset classes that fall on this chart. And the takeaway being, again, if we can prudently diversify a portfolio, it can really smooth out the ride. So you can get some sense for that looking at the orange box, which is noted here as balance. So meaning a balanced portfolio that's comprised of both fixed income, real assets, and equities. And you can see that smooth ride. It doesn't operate at the extremes high or low, but really with the idea of growing the portfolio's value over time while meeting some of the volatility.
Now, picking the right investment is important, but what's most important is where are you saving it? We talked a little bit earlier about how it's a rule of thumb to save about 20% of your gross paycheck. Well, where do we save it? Now, we have three different categories that we could consider as retirement savings. And the first thing you'll notice on this page is that although two categories are for retirement accounts, there's actually one category that's non-retirement accounts. It could be individual account or a joint account with your spouse or partner. And an individual account can be comprised of a couple different things. It could be your emergency savings fund. It could be saving for a big upcoming purchase, or it can also be an investment account, a brokerage account for your savings, and we're purchasing those stocks or our mutual funds. Now, one thing to note for this fund is that this type of category, it can include many different accounts. We'd recommend for the emergency fund, or for if you're saving for a big purchase within the next 1 to 3 years, we'd recommend keeping it very liquid and keeping it very conservative, likely in cash. If you need it, we don't want to have to deal with the market volatility. For our brokerage account, we could also use that for investing in a similar way where we would for the other two categories. The next category being your retirement plan through your employer, that 401k plan. Could also be a traditional IRA. In these instances, money can be pulled before it's taxed from your paycheck to be contributed to your company 401k. Now, this would be important, especially from taxation purposes, because as it grows tax-free, once taking withdrawals in retirement, those would be taxed. Now, in another category, we've got our Roth accounts, either a Roth 401k or a Roth IRA. These would be paid with after-tax dollars, would grow tax-free, and you'd take out in retirement free of tax. These are all different. They're taxed differently. And for that reason, they do all three of them have a benefit within one's retirement plan. Now, one thing we'll bring up as a way to maximize your retirement savings is to take advantage of the company match. So within a company 401k plan, as an employee, you're most likely promised a percentage of your contribution and your employer will match it. It can be 3-6%. You only receive that company match if you contribute to the 401k plan. So each of these categories has a specific place in your retirement plan. We recommend diversifying each of these plans and making sure there's adequate balances in each of them because they all have positive benefits.
Colleen, for somebody's on this call who might be wondering, well, that's great, I should save 15 to 20% of my income. Where do I even start? I understand there's three different buckets we have here: taxable accounts, pre-tax or traditional, 401k, Roth 401k, Roth IRA. Can you give some general words of wisdom or thoughts on where to start?
Yeah, that's a great question. And something that we should definitely point out is the number one place to start would be your company 401k plan. Take advantage of that free company match. It's a free benefit to you as long as you are contributing to your 401k. That would be our number one goal. And not many people know that. There are some people that I know that I've even spoken to over the years that didn't know or care to take advantage of that company match. That is free money and our number one thing to take advantage of. So now, as we're talking about 401ks, the most important thing too is take advantage of that match, take advantage of it early because time is your friend. The most important tip with saving for retirement is to start early. And there are three reasons why. So first, let that growth be compounded by more growth. As your investment returns keep growing, it'll keep growing on top of that initial growth. Next, consider a set amount each month, whether it's to your 401k or in addition to adding to a brokerage account, consider a set amount each month to save, and you can automate these things. And then lastly, increase that savings over time. As you receive a raise, increase your savings amount as your monthly budget allows. And so we have an example here of why time is your best friend. And we have this simulation where for this purpose, why don't we compare consistent Chloe to late Lila, the top two? And the difference between these two individuals and what they saved was that Chloe started saving 10 years before Lila did. They both saved $200 a month up until age 65. Chloe was 10 years sooner. So all Chloe did was save $24,000 more than Lila, but it had those 10 extra years of compounding before Lila started. The difference at the end of the day from that additional $24,000 was an ending portfolio value that was $210,000 more, all because of the power of investing early, the power of compounding. So this works in retirement. It also works for saving for a big purchase or even college savings for future children. The sooner and the more consistent you save in a well-diversified portfolio, the better off those savings will be. So we covered the importance of starting early, but why don't we perhaps cover some of the pitfalls that investors might find themselves subject to?
And this is almost, it could be its own standalone webinar, so we'll cut through this section pretty quickly here, but some really needy information to get through. There was a great article penned by author Morgan Housel about 8 years ago in the Wall Street Journal. We recommend that you look it up in your free time, but it's called 16 Rules for Investors to Live By. Some great words of wisdom, just thinking about longer term market cycles and having the right investing psychology. And certainly something that we continue to advocate to our clients to keep the longer term in mind to avoid dangerously reactive investment decisions, particularly when markets get volatile. So we'll just cover the first bullet point, but a great quote and one that I've shared often with clients. Short-term thinking is at the root of most investing problems. If you can focus on the next 5 years, while the average investor is focused on the next 5 months, you have a powerful edge. Markets reward patience more than any other skill. And just taking a step back, when you think about popular media, often it's geared for, is now the right time to get into the market? Is now the right time to sell? What are the hot stocks or hot sectors you need to own in your portfolio now? So we're just advocating, don't miss the forest from the trees. Keep that longer term mindset in mind when you're really trying to invest for longer term success.
Well, and Nick, that's an interesting point that you bring up, because I think this whole Reddit, finance, stock tips, and even thinking about GameStop, I think a lot of people invested in GameStop for a short-term play. And you heard about the people who made it big. But what you didn't hear about is all the people who didn't sell fast enough and lost money on their investment. And so this is exactly what we're talking about here and what many GameStop investors were learning.
Yeah, and that's a great point, Colleen. And I think we can also think about cryptocurrencies, right? That there's been individuals that perhaps felt like they missed out on the run up and probably invested at the wrong time. And some sad stories of individuals who unfortunately lost a lot of savings trying to chase today's mania or fad. So I think it's important, just for backdrop and context, in light of the fact that we've seen markets pull back pretty substantially year to date, just providing some longer term perspective. So we certainly recognize that market pullbacks can be stressful and trying for investors. But the reality is, for investors with a longer term time horizon, you shouldn't let market volatility change your perception of your time horizon. Important to keep in mind that market pullbacks are a normal occurrence in the context of longer term market cycles. Oftentimes, when we get in periods of elevated market volatility or uncertainty, investors feel like this time is different, or we've never experienced this before, but that's really not the case. And in fact, the bear market that we recently breached that area, so more than a 20% decline from a recent peak, on average has happened once about every 8.5 years, looking at about the last 75 plus years of market data. So I think it's important just to remind ourselves that yes, markets have been through these types of pullbacks in the past. And I'd also add that historically markets have recovered quicker than I think most investors might otherwise think. The final point that would make on this slide would just be that trying to time the market can have severe consequences. And we're talking about timing the market. It's trying to figure out, is the market at a bottom? Do I buy now? Or is the market at a peak? Do I sell now? The reality is that most investors can't pull that off, making those types of timing decisions. And numerous academic studies have shown that missing just a few days of a market rebound can severely impair longer-term portfolio returns. This slide is one that we affectionately call climbing the wall of worry. So it looks at a period from 2009 to 2019, just looking at S&P 500 index. And from a 30,000 foot level, you can see that there were a lot of headwinds or challenges that really weighed on investors' sentiment or could have presented challenges to market returns. And yet, after that 10-year period, the S&P 500 index had cumulative total returns of about 500% over that 10-year span. So stated simply, the longer-term market trend is positive. There's certainly going to be blips or pullbacks along the way, but that shouldn't deter one from being really steadfast and saving for the longer term. For more research and insights, please go to our website. You can certainly find additional insights available on our Insights tab. As always, please feel free to reach out to any professionals at Fiducian Advisors. Kelly, looks like we have a couple minutes left. There's a couple questions that came into the chat box. So the first one that came up was, I've heard that having multiple credit cards automatically lowers your credit score. even if you pay them off all every month. Is that true? And if so, is there a limit to how many cards you recommend? Any thoughts on that?
Yeah, so what we would recommend is keeping that number small. There's no number that I particularly have in mind, but being very cautious and careful and very pointed on when you do open a new credit card. Does it have great benefits and is it worthwhile? Keeping that number small is important. And then also, really important note would be don't take out any new credit cards when you're applying for a loan for a car or for your home. That can also, it's a short-term impact, a drop on your credit score. And then lastly, be wary of what credit cards you close. So that definitely negatively impacts your credit score.
And I think you had pointed out on the earlier slide, one of the challenges is if you're applying for multiple cards within a short amount of time, that's probably the bigger risk. I think I've seen stats before that the average American has something like 4 to 6 credit cards. So, you know, to Colleen's point, if you keep it small, maybe having 2 or 3 credit cards to start and you're not applying for them all, you know, at the exact same time, keep that in mind. The other thing that I would add is, you know, oftentimes if you're at a retail store checkout, they'll say, hey, would you like to open up a credit card? You can save 5 or 10% on today's purchase. Really take a step back and think about, is it really worthwhile opening up another credit line relative to what credit cards you already have? There was a question that came up on cryptocurrencies. You know, the thing that we would point out here is just be a little bit cautious as far as what percentage risky investments comprise of an overall portfolio. So typically, you know, what we'll call a cowboy account might be 5 to 10% max of an overall investment portfolio. So making sure you're not making really, really concentrated bets on cryptocurrency or select stocks and allowing them to become an outsized portion of the overall portfolio. There was a question here on Roth IRAs. Is an inherited Roth IRA taxed? You want to take that one, Colleen?
Yes, so that one, so inherited IRAs or Roth IRAs do have different rules. And so once it's inherited and passed down to an heir, that would require taxation.
Yeah, so an inherited traditional IRA would be taxable, an inherited Roth IRA would not be. But there are new spend down rules. So before you could just take withdrawals over your life expectancy, new rules that are in place generally force an individual inheriting a retirement account to spend it down over 10 years with limited exceptions. There was a question here on I-bonds or inflation-linked bonds. There's been a lot of press related to that, just given what we've seen from inflation recently running, you know, north of 8% year over year. You know, it's certainly an interesting vehicle that allows investors to perhaps get some return in an elevated inflation environment. The challenge there is that you're generally limited to a $10,000 annual purchase. So as a couple, you could purchase potentially up to $20,000 a year. And there's also a provision that you could additionally invest up to $5,000, I believe, of a tax return refund towards the purchase of I-bonds. But important to note, you need to make that purchase directly through treasury.gov if that's something that's of interest. There's been a lot of articles in popular press such as Barron's and Wall Street Journal for those that might be a little bit more interested on that. There was a question that came up as far as apps or websites for tracking expenses. I know that I personally use mint.com and like that a lot. Colleen, do you have any that come to mind?
I use mint.com as well. And so in mint.com, you do have to agree to the fact that you are typing in your username and password to this website. It is also owned by Intuit, which is a big accounting software. So I personally find it trustworthy. Nick does as well since he uses it too. But I would look into it depending on your degree of comfortability with that sort of security. But what it's able to do is it tracks every single expense that comes through on any account, credit card, bank account that's linked. It'll automatically try to categorize that expense. And then you can also make edits if you don't agree with the way that it automatically categorized it. So that is the number one best way that I myself use budgeting apps.
Yeah, I would agree. There's a number of budgeting apps out there. Again, Mint's just one that we use. from a personal level. But again, it requires a little bit of legwork on the upfront end, as Colleen mentioned, to make sure that various expenses are properly tagged, but provides a nice way to really track on a month-by-month basis where your spending is actually going. And I think on that note, the other thing that we didn't cover was just, certainly there's a big push for a number of providers to go to subscription fees, right? So think about Netflix, Hulu, Apple TV. So, be a little cautious there on your monthly budget spend. You can very easily sign up for a lot of $10 a month, $20 a month subscription services and find that actually being a meaningful number if you're not a little careful on that end. Well, with that, we were 30 minutes on the nose. It looks like all the questions that came in. Again, thanks today for those that were able to attend. Again, find more research and insights available on our website. And as always, if you have follow-up questions, please feel free to reach out to any of the professionals at Fiducian Advisors.